let's just break it down on who are the worst ones. The worst is, of course, Malaysia and the Philippines. And Malaysia, because of its suppression measures and also its exposure to oil and natural gas, and as a result, we have a sharp decline, the sharpest in Southeast Asia, but it's actually has gradually recovered much better in the Philippines. The Philippines is the second worst. And the reason for that is, as I mentioned, it's a very domestic demand-driven economy. For external side, depends on remittances and exports, but those exports are a very small share of the economy. So when you lock down the economy, you lock down the key driver to growth. And on top of that, it didn't really have, and it still doesn't, the fiscal space to really mitigate this impact, right? The same way that you would see in Australia or in the US and in the developed markets. So the bright star of Southeast Asia is Vietnam. And Vietnam is, for all the reasons we mentioned, but opposite, right? So Vietnam, of course, have exposure to tourism, etc., and exports, but because it's a much more diversified economy where manufacture exports, especially in sectors that do well, such as electronics and even the making of masks, etc. And as a result of that, exports have been quite resilient. The second factor is, of course, it contained the virus. It locked down the country quite early on in January, and it continued to do so. And as a result, the lockdown was very limited in timing, and it was mostly containment. So although it doesn't have the mobility of international travelers, it has better mobility domestically. And as a result of that, it didn't really need a lot of fiscal or monetary stimulus as other countries. And I think that is also paving ways for it to also recover better, because it's not adding to this level of debt that other countries may have to deal with. Very skewed towards tourism, which is essentially dead, and that's a double digits of the economy. And if you include all the other indirect sectors, is almost as high as 20% of GDP. So for some provinces, it's very, very catastrophic. And of course, it has the fiscal space and the monetary space and the savings to offset. But because of the political situation, it also used the emergency extension way too long. And it also creates a weakening sentiment, as well as the limited ability of the government to really look at this and diversify the economy, which they correctly identify. But because of the political situation, that has not been prioritized as much. Well, the risk factors are different for across different countries, but the most obvious one is COVID and evolution of COVID, right? Not just within these countries, but globally. So when we think about the evolution domestically in these countries, of course, it makes, if you know, it's going to get much worse and you have to deal between debts versus livelihood. People tend to just mitigate the impact of debts, and then the livelihood situation becomes kind of a terrible situation, right? So we assume that that's not going to happen, because the ability to these countries, particularly the ones worst hit so far, like Indonesia and the Philippines, don't have the fiscal space. The second one, of course, is the external mobility situation. And here we have to ask the question of, you know, given the news of the vaccine and also better treatment so far, are we going to have the same trend that we have now into 2021 for global mobility is completely suppressed? And when that is the case, economies are very dependent on that, will be further hit, right? Of course, you have countries like Thailand, and even other countries too have a very high share of tourism, although not as much as Thailand. So that's a huge risk factor, COVID, the question mark. And I am of the view that things are getting better in terms of treatment and in terms of understanding the virus. So hopefully, but we won't have to talk about this issue when we revisit this in 2021. And the second question is the overhang of what has happened, right? There are two different overhangs. One is the debt situation. So when you deploy more public funding, that means that you need to pay back, right? And the third part is, of course, how are we going to improve the standards of living? Because we're talking about emerging markets. You know, if we talk about Malaysia and Thailand, high middle income or middle income, whatever, but there are many countries that are low in middle income or middle income, so it needs to move up. So in 2020, to deal with the lack of external financing, particularly by countries such as Indonesia and the Philippines, the imports decline sharply. So when you have a decline of imports, you have less demand for dollar, which actually it's great for your balance of payments and the way you do the accounting of the national budget, but terrible for your standard of living, right? You shouldn't expect a country already as an emerging market to have much lower standard of living in the future. So where are we going to get this income source from to get back to where we were before COVID and even improve from that? So before we talk about the benefits, we have to think of what's up for grabs, right? So when you think about the diversification play out of China, it actually started before the US-China trade war, and actually started with the fact that China has gotten more expensive, especially for labor intensive, as working age population declines, as income rises, all these factors pushes up wage costs. Second factor is the policy priority, right? So when you hear from China, it wants to move up, it wants to vertically integrate the value chain. On the tech side, it's not really talking about labor intensive, although it still needs a lot of jobs, and jobs are a problem, but it's not really a policy priority. As a result of that, the regulatory framework is not as favorable for a lot of these economies. So there's a bit of a push out of China, and so that depends on the pool. And of course, another push was the tariffs on top of that, on top of all these economies. When they look at a lot of these mini geopolitical conflicts, whether or not it's Japan, South Korea, Taiwan, etc., they realize that they're too reliant on China. Putting all your eggs in one basket is never a good idea, especially where there's global power, superpower confrontation, right? So there's that. So what is up for grabs is a question. What is not up for grabs is that if countries want to take advantage of China itself, that will continue because, you know, it's a massive market. You would want to go there. And that's why sectors like e-commerce, services like finance, and even high-tech manufacturing still do well in China. What's up for grab is what I just mentioned. What is the deterioration of competitiveness of China in terms of labor intensive, in terms of wage costs, and just overall costs, will want to exit and find alternatives. And of course, in addition to that, you have this diversification push as well to hedge the supply chain. You can't have all the products made there, even though the supply chain is there and it's very favorable. So as a result, the countries that benefit will also reflect that, right? The, you know, good examples, Vietnam, labor cost arbitrage. It started before TPP. It continued after TPP died, and it continued after Trump US-China trade war. So that will be the case. The issue is how much Vietnam can absorb. There will be some in Thailand and Malaysia in the middle tech, and you can see investment trends going that way. So the question mark is, what about the Philippines and Indonesia, right? Indonesia is the fourth most populous economy in the world and largest in Southeast Asia, and everyone talks about it. But the fact is, it's not on the radar because it doesn't prioritize these sectors. And as a result of that, the FDI that goes there is very similar to China in that you go there to tap into these markets. So you do have, it's more like a domestic oriented story. And I think what they need to do is to move beyond that. So you want that as well, but also to use your inherent comparative advantage, which is your cheap wages and etc. And when it does so, and it unshackle its labor market, unshackle its investment environment, then it can be a huge player. And it is the biggest player and the only one that can be a game changer because Vietnam is too small, right, to absorb this diversification push out of China. Capital chases return, it chases return, and that return is very different. It depends on different countries, right? So you want labor intensive, you want an environment where countries that prioritize trade liberalization. Vietnam has an EU FTA. It's very aggressive in liberalizing. It's prioritizing. It's giving all these benefits. So you chase returns in sectors that match with the profile of that country or where you think the country is going, if you think that the policy itself is going to change, right? So I think it's very different depending on countries. I mentioned Vietnam is both a domestic demand play and it also gets an FDI for manufacturing arbitrage. To a lesser extent, Thailand is not going to have this domestic demand play because it has a shrinking, or what I say, not necessarily shrinking, but an aging population. And not only that, with the political situation and the uncertainty, you actually see Thai corporates moving elsewhere to capitalize on the higher growth, right? So if you look at private investment in Thailand, it's actually declined. So the story is actually, even within Southeast Asia, you have firms trying to chase return within it, not just people outside of Southeast Asia, right? So I think the story is very different. The story for the Philippines and Indonesia are still very domestic demand, which is a direct juxtaposition to Thailand. So that's why you see a lot of Thai companies going into these economies. You probably will see Japanese or whoever else. So it's a really different question. So the big question mark for Southeast Asia, the story we know is Vietnam. The story we know is Indonesia as a domestic demand story and oil, not oil, commodity story. But is it going to be a manufacturing story, right? And I think that story is very exciting and one that I try to keep on top of and very excited to see the details and how they implement this reform bill that they have. And if they're actually going to make that huge leap forward, I think it can be a game changer for FDI as well, right?